Two men. Same age, same city, same income, same discipline, same exact $100,000 sitting in the bank. But one decision splits their future into two completely different lives. Peter chooses real estate. Paul chooses index funds. At first, Peter looks smarter. He buys a property with leverage. A bank helps him control an asset far bigger than his own cash. The numbers feel powerful. Rent starts coming in. The property appreciates. His net worth climbs faster than almost everyone around him. Meanwhile, Paul does something painfully boring. He puts the same $100,000 into index funds, and then does almost nothing. No tenants, no property agents, no repairs, no phone calls at midnight. Just patience, discipline, and time. And that's what makes this comparison dangerous. Because by year 10, Peter looks like the obvious winner. His wealth appears bigger. His life looks more impressive. Social media would crown him the genius. But hidden beneath that image is something most people never calculate. Interest payments, maintenance, vacancy risk, taxes, insurance, unexpected repairs, the mental cost of active management, the invisible price of stress. And when those numbers start stacking, the story changes. Because Paul's boring money keeps compounding quietly in the background. No friction, no emergencies, no debt pressure, just market growth doing what it has done for decades. So here's the real question. Which strategy actually creates more wealth after 20 years when you include the full math, not just the flashy headlines? Because the answer is not what most people think. By the halfway mark, Peter seems miles ahead. But by the end of the race, Paul's silent strategy may completely rewrite the scoreboard. And that's exactly where this gets interesting. I'm Caesar, and I'm on a mission to take you to financial freedom with simple, straight-to-the-point money breakdowns that actually make sense. So if you enjoy simple, no-fluff finance videos that expose the real math behind wealth, subscribe right now and drop a comment below telling me which side you think wins, real estate or stocks. Because by year 10, Peter looks unstoppable. But the longer this race goes, the more dangerous appearances become. And by year 20, Paul's boring strategy may completely change the story. Peter makes the move that instantly looks smarter. He takes his $100,000 and uses it as a 20% down payment on a $500,000 rental property. In one decision, his money becomes 5 times more powerful. This is the seduction of real estate. With a single purchase, Peter now controls an asset worth $500,000. Not because he had the full amount, but because leverage allows the bank's money to start working beside his own. And emotionally, this feels incredible. He now has a house, a real physical asset standing in the world. Walls, doors, land, something tangible he can point to and say, I own this. Then comes the tenant. Every month, rent lands in his account, and that cash flow creates a powerful sense of validation. The property feels productive, alive, like money is finally doing something visible. At dinner conversations, Peter sounds like the smartest person at the table. While everyone else talks about stock charts and percentages, Peter talks about a real house, a tenant paying him every month, the equity building in the background, an appreciating neighborhood, a visible asset people instantly respect. This is where real estate gains its psychological advantage. It doesn't just build wealth, it feels like wealth. There's social proof in saying you own property. There's emotional certainty in seeing something physical. There's status in being the landlord. And for a while, Peter genuinely looks like he's winning. But then the real math begins. The property tax bill arrives. Then insurance. Then a plumbing repair he didn't expect. A few months later, the tenant leaves. Now the house sits vacant. No rent. Same mortgage. Same bills. Momentum suddenly feels fragile. Then another tenant moves in and turns out to be a nightmare. Late payments, damage to the walls, appliance issues, more repairs, more money leaking out. And just when things stabilize, the roof needs replacement. A single capital expense wipes out months of cash flow. This is the side of real estate most people never include when they brag about returns. The rent check is what Peter talks about. The expenses are what decide whether Peter is actually winning. Because every hidden cost changes the real return. Taxes, repairs, vacancy, insurance, bad tenants, major capital expenses, the time cost of managing chaos, and the stress cost of carrying debt on an asset that constantly demands attention. Still, despite all this friction, leverage keeps doing something powerful in the background. The tenant is paying down Peter's loan. The property may still be appreciating. His equity keeps rising even during the messy months. That's what makes this race so compelling. And because Peter's path still looks stronger. He controls $500,000 with only $100,000 of his own money. And that raises the question that keeps this battle alive. Can Paul's quiet, boring portfolio really outperform an asset Peter controls with the bank's money? Paul takes the same $100,000 and chooses the strategy almost nobody celebrates. He buys broad market index funds. That's it. No mortgage broker, no tenants, no repairs, no phone calls in the middle of the night. At first, the decision feels painfully unimpressive. Peter has a house people can see, a tenant paying rent, a visible symbol of progress. Paul has numbers on a screen. Nothing about it feels exciting. And psychologically, that's the real challenge. Because Paul's edge is not action, it's restraint. He does the one thing most people fail to do. He leaves it alone. No panic selling during crashes, no chasing hype, no trying to outsmart the market. Just time, discipline, and dividend reinvestment quietly doing their work. For the first few years, it feels like Peter is clearly winning. Peter feels rich. Paul feels invisible. But this is where the psychology flips. Because compounding doesn't reward excitement. It rewards endurance. Compounding rewards people who can survive looking unimpressive. By years 7 to 10, the gains begin to accelerate. Now Paul's returns are producing their own returns. The growth itself starts becoming the engine. His portfolio begins moving faster, not because he is adding more money, but because the money already there is multiplying itself. And by year 10, the gap between them is shockingly small, which is exactly why the second half of this story becomes so dangerous for anyone who judged the race too early. Fast forward 20 years. The race that once looked obvious no longer feels simple. Because now, the scoreboard forces the question most people avoid. What did the wealth actually cost? Peter's property, the one that started as a $500,000 rental, is now worth somewhere between $900,000 and over $1 million. On paper, it looks incredible. 2 decades of appreciation have transformed one leveraged decision into a massive asset. The mortgage that once felt heavy is now almost gone. Years of tenant payments have quietly chipped away at the principal. His equity has grown into something undeniably powerful. This is the dream that makes real estate so attractive. A visible asset. Massive equity. Years of rent collected. A property that now feels like a wealth machine. And yes, Peter is wealthy. But the full story lives in the invisible cost of getting here. Because those 20 years were not passive. They were filled with repairs that arrived at the worst times. Vacancy periods that created panic. Insurance increases. Tax bills. Tenant issues. Capital expenses that wiped out entire years of cash flow. And hanging over the entire journey was one constant pressure. Debt. For 2 decades, Peter carried leverage risk. A powerful tool when things go right. A dangerous weight when life, markets, or tenants go wrong. His wealth grew through control, effort, and the willingness to absorb stress most people underestimate. Now look at Paul. The same $100,000 that once looked boring has spent 20 years compounding in silence. No visible milestones, no social proof, no dramatic dinner table flex. Just time doing what almost nobody respects early enough. The market rises. Dividends reinvest. Returns build on previous returns. And eventually, the portfolio reaches something shocking. Somewhere between $850,000 and $1 million or more. Nearly the same wealth range, but with a completely different emotional journey. Paul's money stayed liquid, diversified across the broad market, accessible at any time. No tenants, no midnight repairs, no debt pressure, no concentration risk tied to one physical asset. Just behavior and patience turning simplicity into scale. And this is the stomach drop reveal. After 20 years, Peter and Paul may finish in almost the same wealth range. The flashy strategy and the boring strategy can land in nearly the same destination. But the path could not be more different. Peter built wealth through leverage and labor. Paul built wealth through behavior and patience. That's the line most people never forget. Because this comparison was never just about the final number. It was about the lifestyle attached to the number. Peter's wealth demanded attention, management, and emotional resilience. Paul's wealth demanded belief, restraint, and the discipline to ignore the need to look impressive. Same starting money. Potentially, same ending wealth. Completely different lives lived on the way there. And that's what makes the final decision far less obvious than social media ever admits. After 20 years of watching Peter and Paul build wealth in completely different ways, the final answer becomes clear. The winner is not real estate, and the winner is not stocks. The real winner is the strategy your psychology can survive for 20 years. That's the truth most people miss because they're obsessed with spreadsheets and blind to behavior. Money is never just math. It's emotion, discipline, stress tolerance, patience, the ability to keep making good decisions when the path stops feeling exciting. Peter's strategy wins if your personality is built for leverage. If you understand how debt can amplify returns without letting it destroy your sleep. If you can manage systems, people, and problems without becoming emotionally reactive. If you want the tax advantages, the forced equity buildup, and the control that comes with treating wealth like a business. Because that's what real estate really is. Not passive magic. A business wrapped in an asset. And for the right person, that business can become a wealth engine. But only if the responsibility energizes you instead of draining you. Paul's strategy wins for a completely different kind of mind. If you value simplicity over status. If liquidity matters more than control. If you want freedom from phone calls, repairs, and debt pressure. If you can stay consistent when progress feels invisible. If you trust long-term compounding enough to ignore the temptation of constant action. Because stocks reward a rare skill. The ability to do less. To stay calm during crashes. To hold through uncertainty. To trust boring discipline longer than most people trust excitement. That is not easy. It just looks easy from the outside. And that leads to the core money truth most people spend decades learning. The best investment is the one that makes you richer without making your life heavier. That line changes everything. Because wealth is not just about arriving at a number. It's about the emotional weight you carry while getting there. If the strategy grows your money but slowly steals your peace, your time, or your freedom, the math is incomplete. The smartest investors don't just optimize returns. They optimize for a life they can actually enjoy. That's why Peter and Paul both won. Not because one asset class is magical, but because each one stayed aligned with the behavior required to make the strategy work. And that's the real lesson. The best portfolio on paper means nothing if your psychology can't hold it through the ugly years. So now the question turns to you. Who are you more like, Peter or Paul? Type Peter in the comments if you'd choose real estate. Or type Paul if you'd choose stocks. And if you enjoy simple, straight-to-the-point finance breakdowns that actually show the real math behind wealth, subscribe right now. Because the game changes again when Peter eventually buys stocks. Paul eventually buys real estate. And both combine the two strategies. That's when wealth stops being fair and starts becoming exponential.